Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And today we're going to be talking about selling puts, and specifically, we're going to be talking about why some traders prefer to sell very short-term puts. We're going to be talking about what might cause them to be attracted to that sort of an approach to selling options for income. But I also want to talk about maybe some of the sort of hidden trade-offs that can come with those shorter term contracts. So I think this is going to be an interesting discussion. We're going to be planning and placing an example trade before we're done. But before we can get to any of that, let me first of all say hello to everybody who's already chatting in out there in YouTube. Great to see all those familiar returning names. Great to see, yes, there are some that are here that are new. So hello there, Will and Janelle, Naresh. Who else do we have? We have Olga, we have Mark, everybody else, Roy Walsh, everybody else, thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you are among those who are here for the first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us in the live audience. This is a Monday webcast series, and we kick things off promptly at 2 Eastern time. Now, I also want to let you know that my very good friend James Boyd is hanging out there in the chat on YouTube with the live audience. He's going to be watching for any questions that come in that I can't get to just during the flow of the presentation. He's going to help me pick up the slack there. So thanks for having my back there, James. James and I have now been working together for about 2 decades. And just about everybody watching this would know who James is. He knows, what a great degree of experience he brings to this discussion. Thanks for being there, James. James and I would also like to issue an invitation to everybody listening, whether you're on the live session or you're watching on the recording, to follow your favorite Schwab presenters on social media. You can find and follow us on X or on LinkedIn. You can find James and me on X. Just go for James at James Boyd CS is his handle there. You can follow me on X at Cameron May CS, or you can pop over to LinkedIn. Just go to linkedin.com/in/Cameron May CS to find me there. But let's go right to this discussion. And as we do this, risk is real when trading options. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. And since actually this is a discussion of covered calls and short puts, let's just expand that out and say risk is real when trading or investing in pretty much anything with the potential for gain carries the potential for loss as well. But options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today's discussion. Today is going to be about selling those short-term options. Specifically, we're talking about selling puts today, but I want to talk about those options in maybe just a few days from expiration to possibly out to maybe a couple of weeks. So not a lot of time on these contracts. There are a certain set of traders who tend to be attracted to those shorter term income strategies. So I want to talk about why they might be attracted to those strategies, but then also the risks that are attendant to they come along with this sort of an approach. So we're going to be weighing the pros and the cons of selling short-term puts for income, and then we're going to be planning and placing an example trade today. Now, I'm going to kick things off, though, with a quick review of our current positions in our example paper money portfolio and a quick look at what's going on with the market. So let's go right to that. Let's go to the Thinkorswim desktop trading software platform. Right now, we have 2 positions in our example portfolio. So let's have a look at both. Both of them are doing well. But I think there's an interesting development in particular with Cardinal Health. So let's go see the history of our Cardinal Health position. As we go to our chart here, we can see that we originally bought shares all the way back here. It's been nearly a year that we've owned the shares in our example portfolio. These shares were purchased at 155.40, and then they were just kind of left to do their own thing for a while. Now, back in April, though, we decided let's get this involved in our covered calls discussion. So we sold a covered call back in April, just for a short term. Look at this. If you see this little tiny pink dashed line, that represents the entire time frame of our position. This one was designed to be short term, and you can go back in our archives and look at the logic of that discussion. But we sold that call and it just quickly expired worthless. We made a profit of $1.16 per share. But then subsequently, we sold a July contract and we're still in that contract. Sold the July 17th, 230 call for $465. You can see the stock is right now above 230. It's at 234. And we're approaching that July 17th expiration. Right now it's July 13th. So it's this Friday. Today's Monday. This Friday is when this contract expires. Now I will say, even though this contract has gone in the money, this is a paper trade. It's a fake trade. And our fake trades here are never exercised. They're never assigned early. So that's a distinction from real life. Early assignment certainly is possible within a real account, and particularly when a contract goes in the money, and the deeper in the money it goes and the closer we get to expiration, the higher that risk of early assignment becomes. Just won't happen in this paper money account. We'll see how this plays out. But if this stays where it is, if it does get assigned, well, we wind up selling the shares for $230 that we previously bought for $155, and that would be a realization of that gain on the stock, plus the premiums collected along the way. And in this case, actually, plus all the dividends that have been collected theoretically along the way. All right. Now, we also have another position. Let's go have a look at what's going on with our Alphabet position. You can see we own 100 shares. We sold the 17th of July 375 call. So what's going on with that? It actually has a little bit more history to it as well. So we purchased the original shares in Alphabet back here, right here, 100 shares at 349.11. We previously sold a June 410 call. That just expired for a $13.40 profit, $1,340. We're leaving commissions out of the discussion here, but there are commissions paid, paid, let's put that in quotes because these are just paper trades. But just for simplicity's sake, we're kind of setting the commissions aside. So a realized gain here on that call of $13.40. And then we sold the July 17th 375 call. We did that just right here. So whenever you see a horizontal line with this text note next to it, these are things that I've drawn on my chart just to indicate what we've been up to in previous discussions. So recently we sold that 375 call, collected a 315 premium. That was done right here on the 29th of June, and we're waiting to get closer to expiration. We're still below that strike price. Someone in real life, they could still get a wild hair and decide to overpay for the shares by, oh, that would be about 20 bucks right now. Pay $375 or for a $355 stock could happen, unlikely. But our contracts expired just before this earnings announcement. We'll see. Right now, that's out of the money. We're above our purchase price on the shares. Looks like we're in good position to just retain that premium, hopefully as a realized gain here at the end of the week. So we'll see. On both of these, we're well above our break even. In this case, our break even is at 332.34, including the premiums have been collected. And this, in this case, one kind of small dividend right there. So, Mark, you say good choice of strike? Yeah, it's interesting. With both of these, with the one that we sold back in June, you'll notice we sold the 410 call, and during the time of that contract, the highest price was at 408.61. So it got about $1 from that, really close, and then retreated. In this case, we sold the 375 call, and it got up to a high of 373 and change. So again, just a little bit more than $1. It got close, and then it retreated. So we'll see how this plays out. It could reverse, go right back up. In the case of a paper money account, we'd need to be above our strike price for assignment. In a real account, it could even be assigned, even if it's out of the money. But we'll continue to follow this. We'll keep an eye on this next week. But that's our update on what's happening with our existing positions. Morrow says, do you suggest selling covered calls on stocks that shoot out in price? I don't know what you mean by shooting out in price, Morrow. But one thing I will say is I don't suggest anything. We don't make suggestions or recommendations or provide advice. We do educate on these sorts of things. And then the individual self-directed investor, it's just left to them to decide if or when any of these strategies will play a role in their portfolio. I'm impartial on that point. Doesn't matter to me whether someone is doing these strategies or not. It's not my role. But my role is to talk about what the strategies are, what the potential advantages of the strategies might be, and how they may also introduce risk to the equation. All right, John says, if you went in the money on this, would you buy back the call or let the call be assigned? Again, that's a good question, John. That's up to the preferences of the trader. But yeah, if the stock were to rally up here, and again, even if it's not in the money, it doesn't mean that the owner of the call can't decide to just buy the shares anyway. But as long as the contract has not been assigned, then it's up to that trader or that investor to decide, well, while I have the opportunity, do I want to close out this contract, retain ownership of the shares, or do I not really care if the shares get called? I'm okay selling. I want to keep the premium and let come what may with the shares. That's up to the trader. Good question. All right. Let's go look at the markets. What's happening? It's been a nice run for the bulls, and it pretty much continues despite this sell-off. So we're looking at the S&P 500. It's not the only index out there. For some traders or investors, they might try to keep an eye on it, on an index that might be a little bit more closely aligned to their portfolio. So if they have more small cap stocks, maybe they're looking at the Russell. If they have more technology stocks, maybe they're looking at the NASDAQ. But we're looking at the S&P as sort of the stand-in for how the markets are doing. And with the S&P, for the last couple of months, prices have rallied up and then fallen back and rallied up and fallen back and rallied up and fallen back, and of those component companies adding up to kind of average levels, really topping out at a similar point about 4 times now. So the highs are not getting higher, but the lows are. You'll notice as we've been pulling back from these cyclical highs, we run up and then pull back and just not as far. We run up and then pull back and not as far. What do we call that when the highs are going pretty much sideways, but the lows seem to be rising? And this tug of war between buyers and sellers, maybe the sellers are kind of getting exhausted. At least that's the way this might be typically interpreted. This is typically seen by technical traders. This is referred to as an ascending triangle. So it has a triangular shape, but prices net are ascending, going up. And it's commonly interpreted as a potential continuation signal of whatever the trend was before. Actually, an ascending triangle is assumed to be a bullish continuation pattern. So a trader might anticipate that if we can finally break through this ceiling, maybe that previous trend will continue. Is it guaranteed? Of course it's not guaranteed. We'll see. But let's just say that we are that trader who has that sort of bullish outlook, but we're also income oriented. That's what this webcast series is all about. Covered calls and short puts, both of those are income strategies, and they're both bullish. So let's say that we are that trader, bullish, income oriented. Let's put on a bullish strategy that carries the potential for income. And for today's example, we're going to be selling a put option. And today's example stock is going to be NVIDIA. All right, so what's going on with NVIDIA? Well, for months, there was a price ceiling around 195. You can't see this. It's a little bit obscured by the candles themselves. If I zoom in here, though, you'll see that level's right at 195. All right, so that price ceiling more recently has been acting as a price floor. Over the last 3 months, there's only been one day, this red candle right there, where we closed really significantly below that 195 level. There was another day, that the next day, it closed at 194.97, which is technically below 195, but it's right there. So in the last month, yep, there have been a few intraday penetrations below 195, but the stock has consistently rallied up above that. But look where we find ourselves right now. NVIDIA has shot up, seems to be pulling back. Well, an income trader may decide at moments like these to, let's say, sell a put. It's a bullish strategy that as long as the stock can remain above a prescribed level, maybe they can just collect that premium and have it expire worthless at expiration. And the one that we'll focus on right now is the 195 level, all right? And I'm going to see if we can maybe do this for a very short period of time. Today's candle on the 13th, we're going to look out to maybe the 17th of July. That's only 4 days away. We're going to look at maybe selling a short-term put. So why do some traders like the short term versus the intermediate or longer term? Well, when they're only a few days on a contract, there's less time for something unexpected to happen. It doesn't require maybe as much mental energy to try to make this long-term projection for what a stock can do over a very long period of time because there's just not that much time. So that's one thing that that might be attractive to some when they're just out there trying to collect an income, not having to worry for a long period of time and wait a long period until that that income is realized, if it is realized. That's an important qualification there. Number two, that might attract traders to these very short-term contracts is that on a per-day basis, the short-term options offer the highest premiums. The further out in time we go on our contracts, the lower the per-day premium that's collected. Let me do a little quick examination of that on NVIDIA. Let's just double check that I'm saying the accurate thing. Let's go to the Trade tab. Let's look at those 17th of July contracts. These are the 4-day contracts here, 17th of July. I'm going to open that up, and remember our price level down there at 195. Let's map out something here. Let's say we're weighing possible example trade with a short put. And specifically, let's say that our trader is considering selling the 17th of July, 195 put. What's that trading for right now? Oh, yep, right there. Looks like it's trading 92 to 95 cents. Let's just say we get 92 cents. We sell at the bid price. Let's say we get 92 cents. So let's say that's trader A. That's 92 cents collected, if we can get that filled right now. How much income is that if we just say, oh, the thing goes to expiration, expires worthless, and this is obviously looking to the future, and nobody has the perfect insight into how this is actually going to play out. But if we get to expiration, this thing expires, we keep that 92 cents times 100 shares. These are traditional contracts. That's $92 of income for 4 days. What is that on a daily basis? Get our calculator out. $92 divided by, oops, let's do it again. 92 divided by 4 is 23 bucks per day to basically put ourselves on the hook. If we don't understand what a put is, we're getting ourselves into a contract where we're agreeing, hey, in exchange for somebody paying us $92, they're going to have the right to sell us shares for 195 bucks at any time in the next 4 days if they want to. That's the deal. Noodlebrain says, wouldn't it be better to sell the put when the stock is going up, not on its way back down? And Noodlebrains, I do think that there would certainly be some traders who would make that case. Yep. Yeah. So rather than waiting for price to be at highs and possibly coming down, maybe they'll wait for price to be at lows and appear to be going up. Now, here's the thing. Just because price is falling on Monday, does that mean that it's going to continue to fall through Friday? Not necessarily. Does it mean that it's going to fall far enough to introduce a high degree of additional threat to this being assigned? Not necessarily. Nor is it a guarantee that because the stock, let's say it's low and it's been rising, that that'll continue. But I will say, yeah, there are going to be some that would prefer that maybe we have a scenario like this where the stock has already come down, starting to move away from our strike price rather than being up and at least currently heading toward our strike price. All right, but let's go back here. And I just want to continue with this thought of that per day income. Let's compare this. How about if we crank this up and let's go way out? How about we go out to a contract that's 10 times further out, right? Well, 39-day contract, if we do some quick math here, theoretically, if we're getting $23 per day, if we were able to do that for 39 days, let's do some math, multiply that by 39, we should get a premium of like $897 instead of just $92. So let's see what we would get. Let's stick with the same strike price, 195. Wait a minute, it's not $897, it's about $640. A $640 contract for the same strike, just longer term time frame. Let's divide that by 39. That's 16 bucks per day. Yeah, it's a smaller premium. And for some, they're attracted to that higher premium. So combination of things. Number one, when looking at the very, very short-term contracts, there's less time for the unexpected to happen. Number two, there's a stronger per day premium that can be collected in just about every scenario I've investigated. Number three is that if we just get into a contract that's only a few days, well, a few days from now, whatever happens, we're done with that trade and we can plan a new trade and adapt it to whatever we think the market environment is at that moment. It actually makes the approach more flexible if we're not committing to a longer term position. Makes the trader who prefers to be a little bit more nimble to be more nimble. So yeah, there are a few potential things that can attract traders to a trade like this. Great. So Cameron, you're saying less time for the unexpected, so not so much pressure to plan for a long period. Yep. A larger per day premium. So, if we have two workers and one's getting $23 a day and the other one's getting $16 a day, doesn't the $23 worker, aren't they just going to make more over the long term? Maybe. They're also taking on more event risk. They could have more trades go wrong because they're doing more of them. Anyway, but it does allow for the trader getting into shorter term contracts to be more adaptable. So all of those things seem to add up to a pretty attractive strategy. Well, that's only looking at one side of the coin. We have to look at the problems or risks associated with this strategy. And one problem is right there on the page in front of us. There are small premiums. Bottom line, $92 to be made on this short-term contract if it works out optimally versus $640 to be made on one that's a little bit longer term. So there's a balance that a trader needs to strike because we all have this, not all of us, but I think an options income seller has a fantasy scenario in their mind. What I would love to do is sell a contract that expires in 5 minutes from right now. Almost no chance that anything is going to go wrong. And I want that contract to pay me 5,000 bucks, and I just want to do that over and over and over again. Little tiny short-term trades with hardly any risk that just have huge reward associated with them. Nope. When we shorten up the length of our contract, a natural thing that happens is that the premium shrinks up until eventually it might diminish to where it's just not worth it. Let me look at an example of that. How about we switch over here? And to go to the question now, Mauro, yes, this webcast is being recorded and it's planned to be added to our playlists on YouTube. Okay, but Noodlebrains had asked this question. Why don't we just do this, but on a stock that's still going up? Well, let's look at ExxonMobil. I don't know if you saw what's going on with oil prices today, but they're going up, and ExxonMobil has reacted positively to that. So let's say that our income trader here sees, oh, prices going the right way rather than going down. They're going up, which is typically seen as more bullish. So maybe I'll do this short-term strategy that Coach Cam's talking about today. And let's maybe look at selling a put right down here at recent lows. That looks like that's around $135 in this case. So I'm going to go to the trade tab. Let's look at those 4-day contracts. And we look at the $135 put, and oh, it's worth 7 cents. I got to pay some commissions out of that. So I'm going to collect $7, then I'm going to pay 65 cents in commissions. There's a couple of risks that we've just introduced there. But number one, these very short-term contracts tend to become with small premiums. Now, there are a few ways that we might address that, but we need to be aware of that as one of the challenges for these shorter-term options. But another thing is the commissions, when we're dealing with smaller premiums, the commissions start to play a bigger role. 65 cents, when you're collecting $640, take 65 cents out of that, it's almost negligible, right? If you're only collecting $7, now the 65 cents is nearly 10% of the premium. So that can have a huge impact. So how might we begin to address this initial issue of these small premiums? There are a few ways. How can we dial up the size of the premium? Well, the first thing that we might do is, go for maybe a few more days. We've already looked at going from, on NVIDIA, in sticking with the same strike and just adding more days, let's say going from 4 days to 39 days, well, that's going 10 times further out. We've increased the premium. Well, maybe we don't want to go 10 times further out. Maybe we just go a little bit further out. Maybe instead of going for 4 days, we go to 7 days. The 7-day contract here looks like it's trading, instead of at 92 cents, trading at around $1.30, 126 to 134. So that has stepped up that premium. It's starting to diminish the impact of the commission, but what's the trade-off? Well, now we're in a contract, a little bit more time for things to go wrong. There are pros and cons to each decision that we make here. What else might we do with in order to get a little bit larger premium while keeping the days kind of short? Well, you might have already spotted it with NVIDIA versus XOM. I actually looked at two stocks that had the same time frame on them, but one's offering a comparatively, can we call it juicy, a bigger premium, and the other one is almost offering nothing. What happened there? Two things happened there. Number one is NVIDIA is a more volatile stock. More volatile stocks tend to have larger premiums. So we may not have to go further out in time, but maybe we have to go for a higher volatility stock, and that obviously comes with additional risk. Yep. And one way to gauge the volatility, let me look at this right here on our trade tab. If I go up to the top of the options chain, I click on this little arrow, it'll reveal another line of data. So by default, we're just seeing this quote information for the stock. But if we click on the little arrow on our trade tab, we can see more information. Right over here is our beta score. And this has a beta value of 2.2. What is that telling us about NVIDIA? Well, a beta value of 1 means that our stock is basically about average in volatility as compared to the S&P 500. Higher volatility stocks will have higher beta scores. Lower volatility stocks will have lower beta scores. So our NVIDIA has a beta score of 2.2, which means it's basically 2.2 times as volatile as the S&P 500. If we were to look at XOM, it is much less volatile than our NVIDIA stock. So that's why it just doesn't travel as much. XOM on a day-by-day, dollar-by-dollar basis just doesn't travel nearly as much as NVIDIA. And so it doesn't offer as high premiums. Mark, you're actually surprised that NVIDIA is 2.2. If you were assigning things, you might have said, hey, this seems like an even more volatile stock. Yeah, it's a standardized metric, so we may have an impression, and then there's sort of the reality of what's actually happened over the last 5 years. Yep. But Mark, I think, might you go in and reconfigure the algorithm that calculates beta? Possibly. But that is its beta score. Yeah, higher volatility stocks will tend to offer higher premiums. So that's another adjustment that can be made. What else might we do? Let's say we found the stock we want. We don't want to add time. So we don't want to change the stock to another stock in pursuit of higher volatility. We don't want to tack on more time to the contract and, let's say, introduce introduce more days for the stock to misbehave, well, then we might just have to choose a strike price that's closer to the current price. So with NVIDIA, we used 195 as our example because that appeared to be where the price floor is. Well, what if our trader is willing to push this a little bit closer, maybe go up to 200? Well, if we go to the 200 strike, that's offering a larger premium, and not just a little bit larger, it's a lot larger. Like 3 times the premium here. Look at that, 260 to 271. What's going on there? Well, our trader here is saying, all right, I need a bigger premium, or I want a bigger premium, and in exchange, I'm willing to pay a higher price for the stock. That's what they're saying. This trader is saying, if you want to sell the shares to me, I'm only going to pay 195 bucks for them. So if you want to put them to me, go ahead, but 195 is what you're getting from me. This trader is saying, all right, I'll pay you 200 bucks if you decide to sell those shares. Now, in both of those scenarios, if the stock is worth more than that, it's not likely that that contract will be assigned. But it doesn't take much to dip down below 200, and now it becomes comparatively more attractive for that owner of the put to sell the shares at 200 bucks. So we've had a few different adjustments that might be made in the pursuit of higher premiums. We can just go to a different stock that's more volatile. We can go further out in time, maybe still staying under, I don't know, it's up to each individual trader, but maybe they have, let's say, a 2-week threshold, and they've looked at 4 to try to keep it as short as possible. Well, it's going to move it out. Let's move it out a few more days. Or maybe they just look at selling a higher strike price, something closer to the current price of the stock. Each of those carry pros and cons, right? Now, before we go place our example trade, I want to talk about some of the other risks associated with these lower priced options. And we've already addressed one, commissions. Commissions play a bigger role. 92 bucks. If I go place a trade here, let's begin to place this trade. Let's go to that 195 strike. And look at this, the premium has grown. Ooh, why did the premium grow? We didn't add any days, we didn't change stocks. The price has actually fallen a little bit closer to our strike price. So it makes that put a little bit more valuable, and we can collect a little bit bigger premium right now. But let's assume that we're going to do this trade. I'm going to click on the bid price to create our order. We're going to go, in this case, I've set my defaults to just sell one contract or just buy one contract at a time. Let's do that. Let's put an order together to sell one contract. But what we need to keep an eye on, if a trader is doing these short-term contracts, maybe they're only in for 3 or 4 or 5 days, and the trade's over, positive or negative, it's done, and they move on to the next one. 3 or 4 or 5 days, and they're done. 3 or 4 or 5 days, and they're done. Commissions can pile up, but so can the exposure to the bid-ask spread. The slippage, you may have heard that term before, the slippage in a trade. Well, if you're only doing one trade a year, one trade a quarter, it may not be that big of a deal. Here's what I'm talking about, slippage. Slippage is the distance between the bid price and the ask price. So if you don't understand what that means, what the bid price and the ask price entails, that's important when trading options. So when we're selling options, which is what we're doing here, we typically sell at or near the bid price. When we're buying options, we typically buy at or near the ask price. And the way that I think about this is if I were selling anything, I can imagine standing in a room full of potential buyers of whatever it is I have to sell, and I say, hey, I have this thing to sell. What will you bid me for it? And then you sell to the highest bidder. Sellers sell to the highest bidder. On the other hand, if I'm trying to buy from someone, buy anything, buy a car, buy I don't know, a collectible or an option, we say, hey, how much I'm interested in buying that thing you have. How much you asking for it? And then you pay the ask price. And with options and with stocks, there's a difference between the two. So sellers are receiving one price, buyers are paying another price. Well, if I'm paying 97 cents and only 95 cents of that is going to the seller, where's the other 2 cents going? Where's the other 2 cents going, or 1 cent right now? That's going to the individual or the firm known as the market maker. There's a third party here involved whose job it is to line up buyers with sellers. And if they have someone who wants to buy an option and they can't find a seller for that, or if they have someone who's trying to sell an option, they can't find a buyer for that seller, then the market maker steps in and provides the liquidity. They take on the other side of that trade that carries risk, and this is their compensation for that risk. So if there's a heavy volume of these sorts of trades going on, the market maker tends to take a very small amount in compensation. It tends to not be as difficult for them to line up buyers with sellers in a liquid marketplace. Smaller compensation, narrower spreads between the bid and the ask. With less liquid securities and options, there will be a wider spread between the bid and the ask because the market maker's having to work harder, they're having to take more, or they might be taking larger risks, and they're requiring larger compensation. Anyway, another way to think about this, though, when we're talking about the term slippage, is let's say that we just sell this contract. Right now, let's say we get 94 cents for it. That's the current bid price. And then immediately we think, oh, shouldn't have done that. Seller's remorse. Let me buy out of this deal. Sold it for 94 cents, so we go buy it, and oops, the price to buy it is 96 cents. Well, there goes 2 cents of slippage. To dig myself out of the hole, there's always this little bit of give back. That's what we call slippage, and that's a risk. And if we only do it once, maybe we lose 2 cents. But if we're in the habit of doing this frequently, as in the case of someone who sells short-term contracts, that slippage can pile up and it can play a big, important role in the long-term success or failure of the approach. So how do we minimize slippage? Well, some traders just look for very narrow bid-ask spreads. And for those that are trading very short-term, maybe they're looking only at stocks that have a couple of pennies, a few cents difference between these two. Not every stock is that way. It'd be very easy for me to find an example. If I come over here and I look even at S&P component companies, let's look at some of the smaller ones. How about we just do Constellation Brands, STZ. And it's a $135 stock. I just grabbed this at random. Let's look at basically the $135 strike price. If I were to sell a put there, whoa. If I sell a put right now and get $1.75 and I want to buy it right back, I'd have to pay $2.05. That's 30 cents of slippage. You do that once, it's a little bit of a painful mistake. You do that 100 times, and that's tough to dig out of. So narrow distances between the bid and the ask price might be something that traders look for. Okay, now the last couple of things, let's go ahead and place our trade. And then I want to talk about a couple more risks that we've taken on. We talked about the commissions, we talked about the bid-ask spreads, but I want to get into this trade. It looks like it's right at 92 cents. That's our original number. Let's see if we can get that. Let's go here, click on the bid price to sell that put. Let's say we're trying to get 92 cents. I'm going to dial that down, say that we're willing, just because the markets are open, let's say we're willing to accept as little as 90 cents. That'll be our limit, but let's click confirm and send. Selling this NVIDIA 17th of July, 195 put, trying to get at least 90 cents for it. There's that 65 cent commission that's chipping away at that $90 premium, if that's what we get. Let me send that off and see if we can get a quick fill here. But Mark, you're talking about something important. That's what I want to talk about. All right, looks like we got 93 cents. Well, what we just did is we got ourselves into a contract where for the next 4 days, someone has the right to sell us shares for $195 per share. Now, I said that can be attractive. There's only 4 days for the trade to go wrong. Well, that's true, but if it does go wrong, at the moment it goes wrong, let's say it goes down here and all of a sudden it's down below 195, and we didn't actually want to buy these shares. Well, there are now even fewer days, maybe even fewer just hours for the stock to course correct to basically get back to where we want it to be. So yes, there are fewer days for it to go wrong, but if it does go wrong, then there are fewer days for things to get right again. And we have a word for that. If you want to sound fancy, we call that gamma risk. It just means it's a measure of how fast the value of our contract changes according to just a single dollar move on the stock, and how much remaining chance there is for it to course correct. So I think it's easiest to just say, yep, fewer days to go wrong, but even fewer days than that if it does go wrong to get back to where we want it to be. All right. And finally, I think with very short-term trades, maybe the trader is just looking to minimize the risk of assignment. Oh, look at this. And Mark, this is to go Mark's point. Mark says probability of your 195 short put ending up out of the money just ticked above 80%. Yeah, there's not much time for this to get below 195, is there? We can look at that. If we go to our trade tab, we can look at our delta. Delta is basically, it can tell us how much we might make or lose on a $1 move in the stock, but it can also tell us the relative probability that the contract will be in the money and be assigned at expiration, or that it will be in the money to at least a penny at expiration. There's only about a 17% chance of that happening. Yeah, so it's about an 83% chance that it just expires out of the money. So assignment risk can be lower, but we are kind of playing with fire here a little bit. Because one time when assignment risk is greatest is right before expiration. And it might only take just a tick, a momentary tick for that contract to get closer to at the money or even go in the money. And since we're close to expiration, somebody might just decide, I'm assigning, I'm gonna sell those shares to Cameron. So we need to be aware of that. All right, Mark, thanks for calling that out. Guys, we've accomplished what I set out to do today. I want to talk about the pros and the cons of selling these short-term contracts. Yes, there can be things that are attractive to some traders in their pursuit of income. Yeah, there's less time for the unexpected to happen. There's the potential for higher per day income, and we can make ourselves potentially more adaptable to changing market environments, but there are all sorts of cons as well. More commissions to be paid, the bid-ask spread can pile up, higher assignment risk if that thing slips in the money because we're right before expiration, and if the stock does go in an unintended direction, not as much time for recovery. Guys, really fun to have these discussions with you. I hope that you will join me on Mondays as we continue to talk about covered calls and short puts and building our example portfolio. We'll follow up on this trade next week. We'll also follow up on our other two positions, and we'll add a new trade. So I hope you'll join me then. But between now and then, we have a whole bunch of other webcasts going on. I have something new every day of the week. We have 7 or 8 new live webcasts every day and a whole slate of archives that you can review. So make sure, if you haven't done it, to subscribe to our Trader Talks channel, because that's where all the fun happens. Trader Talks Schwab Coaching Webcasts on YouTube is our channel name. You can pop down below the video right now, click on the subscribe button. It only takes a second to do that. It doesn't cost anything to do that, but this is where you can join our live streams. You can find playlists for previous webcasts. I'm going to click on playlists, and I'll just show you where to find this webcast series. I'm going to scroll on down through. This one's it's a little bit beyond the halfway point. So as we come down here, there's covered calls and short puts. Ben filled in for me last week. So if I click on View Full Playlist, there's the whole list of webcasts that we've had previously in this series. Like, for example, if you want to go look at CAH and Alphabet, see why we placed those trades, you can see those. All right. Now, James and I would also like to issue an invitation to everybody listening, whether it's live or on the archive, to follow your favorite Schwab presenters on social media. You can find James and me on X. So you can go to X, find James there at James Boyd CS. You can find me on X at Cameron May CS. But if you find me and follow me there, I post frequently on X. And if you reply to one of my posts, I just try to reply right back to you. So, for example, I think we're going to have a little discussion here. James and I know hot here in Salt Lake. Sometimes we just talk about what's going on in life, or we'll post about the markets. And if you reply there, it allows for communication when the webcasts are not going. And then we do the same thing over on LinkedIn. So if you reply to one of my posts on LinkedIn, I just try to reply right back to you. All right, everybody. So thanks for following me on both of those platforms. I will look for you in a future webcast. I'll also look for you on X. Thanks for everybody for the thumbs up. 114 people watching, and how many have clicked that thumbs up? We've got 44. That's appreciated. That's a pat on the back to your presenter. It also gives me a nice boost in the YouTube algorithm, helps more people find my videos. So always click the thumbs up if you enjoyed a webcast. But I'll see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.